IBM is one of the iconic big tech companies that originated this whole tech revolution. What I want you to notice here, you're looking at operating earnings per share being plotted going back to 2002. And note that up through about 2014 or so, IBM had really strong growth. I used the scroll bar here. It was growing at 11.5%. Now, interestingly, when you put the price on the graph, you can see periods of overvaluation, periods of undervaluation, but most importantly, you see how the price went where the earnings went. Now, as the earnings began to fall, starting with 2014 and so on, you can see that IBM's stock price had followed suit. So the real question is IBM have any investment merit now? Watch this video and we'll answer that important question. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. Once again, proudly bringing you a Subscriber Request Tuesday. On this Tuesday, I'm going to cover 10 stocks, kind of an interesting group of stocks that you guys have asked for this time. I had actually almost 25, but I've cut it down to 10. And I cut it down to 10 that I think offer either important investing insights, important principles of valuation, and just some general lessons on overall investing, total. So let's go ahead and get into the video and look at the 10 companies. The 10 companies I have are really a kind of an interesting group, as I mentioned. As you can see by looking at the GICS industry, I've got healthcare, information technology, industrials, consumer discretionary, consumer staples, and the most often asked for was actually information technology. And these are quite different, and it really speaks to my argument that it's a market of stocks, not a stock market. So I'm going to go through these 10 stocks, talk about them, whether they're fairly valued or not, whether I think they're good investments or not, and what I think you should use them for if you are going to invest in them. So let's first start out with Danaher, which is a life sciences company. Now, Danaher is kind of a very interesting company. I've actually in some ways followed this company for a long time. I want you to notice that the orange line here is a plotting of operating earnings per share. And the company really generated some very consistent earnings growth up until the COVID pandemic hit. And then we had a couple of years of really strong earnings growth after that. And then it's kind of slowing down or settling down back into its normal growth rates, if you will. However, what's interesting about this is notice that when the earnings surged, so did the attitude towards the company. It actually drove it to a very highly valued value. But also notice that since coming out of the Great Recession of 2008 and 9, the market has had a tendency, we've been in this really strong bull market, and we've seen valuations that I believe are unprecedented. And you can see Danaher was trading at very high valuations during that time, but then it got crazy towards the last couple of years, and now we've begun to correct again. Now the question is, has this become a good investment? A couple other characteristics I want you to notice before I go on. The company only offers a 0.39% dividend yield. You can see this white line is the plotting of the dividends. It actually has a pretty good dividend record of raising its dividend quite often. But notice that the area below this white line is the dividend payout ratio. It pays out really only about 10% of its earnings in dividends. So it's not really what I would consider to be a great dividend growth stock. It's always been more of a growth stock. Now, when we're looking at kind of where the company's headed, if I look at forecasting, analysts are only expecting about a 6% growth going forward. So if you applied the normal multiple of around 25 to 30 times earnings, which has been the one for the last 5 years. But if I look at this a little more holistically, I can see that, again, the market has had a high valuation. This might be an interesting investment there, but I would consider that very risky at these levels, although it's trading, again, in line with its normal PE ratio for the first time. As far as the analyst scorecard goes, I also want to point out that this has had a really poor analyst scorecard. Analysts have missed earnings estimates 1 year in advance, and it's been just about as bad whenever making earnings estimates 2 years in advance. So although I like this company, I don't like the valuation. I don't know that I trust any of the estimates, but it's a company that is certainly a lot better buy today than it was a year ago. Now, one of the things that's interesting about FastGraphs, you can go into the external links here and go into the company's website or go into other research sites. I'm going to first go to Morningstar. And I want to make a point here that Morningstar is saying something very similar to what I'm saying. They only give it 2 stars. They said Danaher's intermediate term outlook is uncertain as pandemic likely to turn endemic. They give it a fair value of 200 and the stock trades at 258. Now, if I was looking at this, and, giving it a fair value of 200 would be quite generous to me. I would say the fair value for this company is probably closer to 150 in my estimation based on normal valuations. But anyway, you can see that, they believe the stock's overvalued as well. Now, another thing you can do with fast graphs if you're a subscriber, you can also go into the company's actual website and you can learn about the company. You can go into places like investors and look for events and presentations. And here you'll be able to find a lot of information about the company and so on. So, you can do this kind of thing on your own. There's no substitute for comprehensive research and due diligence. But for my money, Danaher is simply too expensive to really spend a whole lot of time looking at it today. Now, I'm going to go into the summary. I'm going to stick in alphabetical order. The next one would be IBM. I kind of briefly introduced that in the introductory remarks of this video. And you can see this was a really strong growth tech stock for many, many years. But then it kind of ran into a wall, had to go through a transition. Their mainframe business is kind of evolving. Everything's going to the cloud now. So they've been transitioning, which led to very weak earnings now for the last several years. But note the 4.68% dividend yield and the consistent dividend record the company's paid. Now, one thing about this that I think is very important, if I look at another metric like operating cash flow, which is really important to dividend-paying companies, I discover that although IBM has not been growing cash flows very much, their cash flow coverage has been really well above their dividend payments. So the company can afford to continue to pay the dividends they are. The dividends have been growing, but they've actually slowed down that growth. If you look at recent years, the dividend's been only growing at 3, 1, and 1.8%. Prior to that, they were growing at double-digit rates. But again, that's function related to how the operations of the business are going. If you look to the future for this company, and I'm going to go back to the operating earnings metric here, which I like better for valuation, the company's trading at a reasonable valuation and does offer a 10% to 11% rate of return based on a combination of dividends along with modest growth. But, it's fully valued at this point. It's not an inexpensive stock like, I would hope that, most of you would want to be looking for. The next one I want to look at is Inmode Ltd. This is kind of an interesting company. It's a healthcare equipment company as well. If you go into Morningstar research like I did with IBM and look at the company and go into their basically company profile, they provide minimally non-invasive surgical, aesthetic, and medical treatment solutions. Their products and the solutions address 3 energy-based treatment categories. They include face and body contouring, medical aesthetics, and women's health. So it's kind of more of a cosmetic, kind of discretionary healthcare, if you will. What's interesting is the company only has a very short history, but it's grown earnings at a very strong rate in the first 2 years it was out. The stock price followed that growth, and then it got, of course, way overpriced, in my opinion, in 2021. But now growth is expected to slow down, and you can see the stock price reacted to that, and it's now become very inexpensive, even relative to growth of only about 8% going forward. So there is a nice margin of safety. There would be strong double-digit rates of return theoretically available if this stock goes back to its normal valuation methodology. It has had a high PE, but again, the history is very short. It has no dividends. You're primarily looking here at a speculation, in my view, not so much on strong growth as it has historically achieved, but on the stock reverting back, PE expansion, in other words, and reverting back to a more normal valuation. So anyway, that's Inmode, if you will. The next stock I want to cover is Masco. Masco is a building products company. Now, it's very interesting. You can see just the strong relationship between price and earnings or price and operating results. In the long run, a company's stock price is going to go where the business takes, and I think that's such an important principle. And as you can see, coming into the Great Recession, the shareholders kind of suffered quite a bit. The stock was overvalued here, and then coming into the throes of the recession, investors would have lost about 10% annualized, or they would have lost, almost 73% of their money over this period of time. But then if you look at it from the flip side, since coming out of the Great Recession, the company's had very, very strong and very, very consistent earnings growth, as you can see here. So the company's been growing at a very nice rate. If I shorten it down to, 2015, they've grown earnings at almost 19% a year. This orange line now represents a PE of 18.98, or we'll call it 19. It looks extremely undervalued on that basis, but the key is it's forecast to grow at about 11%, which is less than its historical record over the last several years. If it traded at its normal multiple of around 19 or 20, it would be a very extraordinary opportunity. It does offer a healthy dividend yield of 2.17%. They've had a good dividend record. They've increased the dividend kind of nicely, actually expanded their payout ratio. So here's one that for the dividend growth investor and maybe the total return investor that you might want to consider. The stock is certainly cheap enough with a blended PE of 13 and a strong double-digit growth rate potential going forward. So that's Masco. It looks intriguing to me at these levels. The next one I want to look at is Medtronic. Now, Medtronic is another it's called Healthcare Equipment Company. I really found this one interesting because I have a long history with Medtronic, and what I want to point out is there was a time during the irrational exuberant period, 2000, 2001, and here we're starting at around 2002. You can see the valuation of the stock was extremely high. The operating results were very strong, consistent double-digit growth, but yet investors made no money during this period. Even if you measure it from high valuation to its maintaining its high valuation, you only made about 4.7%, and that included dividends and a relatively nice dividend record of growing dividends. So overvaluation was really a headwind here. Now, in 2008, we had a correction, and the stock actually got very inexpensive, actually included a margin of safety here. These would have been the times that you wanted to invest in Medtronic. Today, the stock, had a couple of bad years during COVID. They're recovering. They did recover in fiscal year 2022, which ended in April, I might point out. They're expected to have a flat year from now till next April, and then followed by maybe some double-digit growth again. But I would consider this stock still relatively expensive for what, it's capable of growing in the future. So this would be one that you'd really want to do your due diligence on. If you're able to get this stock cheaper, I would say it'd be worth considering, but I don't necessarily like it at these values. Service Corp International is one of the largest funeral service providers in the world, in the country, certainly. What's interesting about this, and I found this fascinating, I don't know how you feel about it, but the company's been a very, very consistent performer. You can see up through COVID, again, if I use the scrolling feature here, this company was growing at 12 or 13%. The stock price tracked that. It did get a premium valuation for most of that time. But then as COVID hit, all of a sudden we had this huge surge in earnings, and of course the stock price followed that. But now that COVID is kind of winding down, analysts are expecting earnings to kind of revert back to more normal, and that makes the stock very vulnerable, at least in the short run, for a possible correction. I'd want to be buying this stock, if I was going to buy it at all, a lot cheaper. It offers about a 1.4% dividend yield. It's trading at a 17 PE with a 5.77% earnings yield. I consider that a little bit expensive, but it is a very interesting company. The analyst scorecard has been really stellar. The analysts, I feel because of the reliability of dying, I guess. People, we know there's going to be so many deaths a year. And of course, that ratcheted up with COVID. But so this company appears to be relatively easy to analyze. Estimates going forward are therefore possibly trustworthy, but they are expected to have a down year this year, followed by a couple of good years. So that's Service Corp International. Supermicro Computers, a very interesting technology company. I don't know a lot about it. It has a really excellent record, a little bit of cyclicality in the company. Again, one of the best things to do is go to the corporate website and then try to learn, what their various products are, what their solutions offer. They offer machine learning, deep learning, processor solutions, all kinds of technological advancements and stuff. They've had a good growth record. They're expected to have really strong growth over the next 3 or 4 years. I believe part of that is participating in 5G, if I'm not mistaken. As I went through this company, if you go to Morningstar, just use them as a source of information. They give it 4 stars. They give it a fair value of 51, 50.9, and the last close was 39. A 5-star price, there obviously the 5-star price would be 33, a little bit lower than what it's currently trading at. As we continue to go through this bear market, we can look and see how the stock's been performing. It's down almost 2% today. So, the market's giving us an opportunity to buy this. The forecasts are for strong 25% growth going forward. Long-term growth is also expected to be a strong 15% on average. That's more of a trend line growth. If you're looking for a growth stock, this looks like it might be a really good candidate at a very attractive valuation, trading at a PE of 8.5 and earnings yield of 11.7. A little risky, no dividend as you can see, but it is a very interesting growth stock, if you will. Now, Molson Coors Beverage is an interesting one. People really like this stock, offers almost a 3% dividend yield. But when you really look behind the numbers, this has not really been much of a grower. The stock price has had some really strong performance and inexplicable in my way of thinking. Then, of course, that's corrected over the last 4 or 5 years. The stock is undervalued now. It has a very low expectation for future growth, either long-term, which is less than 2%, or even shorter term, the next 2 or 3 years, which is only about 3%. The company's analyst scorecard has been pretty good. Okay, the analysts have had a pretty good handle on forecasting for this company, so you might want to believe these numbers. I just don't see a lot of appeal with this company here recently. It's a very competitive industry. Does offer a decent dividend yield, but it really slashed the dividend during COVID, which I guess is understandable. They've begun raising the dividend again, and there's expectations they might continue to do that going forward. But this isn't really my cup of tea. I don't think it offers enough investment merit to interest me personally. Teradyne is the next stock on my list. It's another semiconductor equipment company. If you look at it post the Great Recession, really had some nice growth, 14%. The market really valued it at a very premium valuation. It is now corrected. It's close to being at fair value now. I'd still consider it a little bit expensive for my taste for the risk you're taking here. Long-term growth is only expected to be about 5.5 or 6%. The analyst scorecard here is a little suspect. The analysts do miss it about 20 to 30% of the time, so take that in consideration. But the stock is certainly coming into fair value. I don't think it's quite got there yet, so that's something you might want to consider. And then last but not least is Vera Bradley, and I think this is a really interesting example to understand the importance of operating results. If you go into this company's website, if you're not immediately familiar with it, they make women's, essentials, handbags, luggage, etc., backpacks, and it's a well-regarded brand, pretty popular. But notice how tough the business has been. It came out with a very, like most IPOs, 2 years later, it was way underwater on the IPO. Earnings have done nothing but, fall for the last, since they've been public, really. There is some expectations of a recovery in this stock coming up in the near future, and even a strong recovery going forward. But on the other hand, if you look at the analyst scorecard, they have a pretty abysmal record here. So, I'd have to figure out why analysts think this company is going to recover and grow so much. But clearly, on a historical basis, this company's price has gone where its operating earnings have gone, and it offers no dividend. It does trade at a low valuation and does have a high earnings yield, but the real question is, they're even expecting another down year this year. So bottom line is, I'm not real keen on this company. Anyway, it's been Chuck Carnival bringing you another Subscriber Request Tuesday. I've covered 10 stocks here, kind of interesting and diverse. I hope you get a sense of understanding what I mean when I say it's a market of stocks, not a stock market. A lot of these companies are really quite different from each other. Some have good growth, some have erratic growth, some have no growth. And of course, where the business goes, that's where the stock price goes. So I hope you enjoyed this video. If you did, give me a like. You might subscribe to the channel. And look how important fast graphs are, how much information they give you without even having to know a great deal about the company. But having said that, they also facilitate your ability to go ahead and research the companies deeper and faster on top of that. Thanks for watching. Give me a like. Take a look at fast graphs as a subscriber. And don't forget to follow my channel for more of this. Thank you. I'll be talking to you again real soon this week. I've got some ideas I want to talk about in this bear market, especially on dividend growth stocks, what's been going on. So look forward to that. I'll probably be posting that tomorrow or the next day. Thanks for watching.